On January 7, 2009, B. Ramalinga Raju, chairman of Satyam Computer Services, sent a signed letter to the company's board of directors and to the Securities and Exchange Board of India. In it, he confessed that the balance sheet of India's fourth largest IT services firm carried cash and bank balances that did not exist. He described the accumulated gap in a single sentence. It was like riding a tiger, not knowing how to get off without being eaten. The number attached to that admission was, in aggregate, more than $1 billion of fictitious assets. The question this episode answers is narrow and mechanical. If a company's cash balance is the single easiest line item for an auditor to verify, how does a fictitious cash balance survive multiple annual audits by a global accounting firm for years? The instrument at the center of this fraud is not exotic. It is the bank confirmation. When an auditor verifies that a company holds the cash it reports, the auditor does not take management's word for it. The auditor sends an independent confirmation request directly to the bank. The bank responds directly to the auditor, stating the balance on deposit as of the reporting date. This procedure exists precisely because cash is the most liquid, most fungible, and therefore most easily fabricated asset on a balance sheet. The confirmation is designed to break the chain of trust between the company and its own reported figures by inserting an independent third party the company cannot control. Legitimately, the process works as follows. The auditor prepares the confirmation request. The auditor, not the client, controls the mailing. The response returns to the auditor's own address, not to the company. The independence of the channel is the entire point. If the company touches the request or the response at any stage, the confirmation is worthless, because the company is the party whose assertions the confirmation exists to test. Satyam reported large cash and cash equivalent balances, and it reported substantial interest income earned on those balances. According to the SEC's enforcement record, the company's filings represented that as of the relevant reporting periods, it held cash and bank balances that were overstated by more than $500 million, with the broader fabrication across accrued interest, debtors, and understated liabilities bringing the total misstatement above $1 billion. What the fraud required, structurally, was that the confirmation channel be corrupted at its source. That is exactly what the record establishes. The architecture had several distinct components, and each one attacked a different link in the verification chain. Step 1. The fabrication of the underlying documents. According to the SEC's litigation release and the associated findings, Satyam generated false bank statements to reflect the fictitious cash balances. The company created forged fixed deposit receipts and forged bank statements that showed interest income accruing on deposits that did not exist. These documents were not incidental. They were the primary evidence a routine audit inspection of the client's own records would encounter. Step 2. The fabrication of the confirmations themselves. The most consequential element of the scheme was the falsification of bank confirmations. The SEC found that Satyam personnel generated forged confirmations purporting to come from banks, confirming deposit balances that were fictional. In substance, the company manufactured both sides of the verification, the assertion and the supposedly independent evidence corroborating it. Step 3. The corruption of the confirmation channel. This is the structural core. A confirmation is only as good as its independence. The record establishes that the confirmation process at Satyam did not follow the independent channel it was designed to follow. Confirmations that should have moved directly between auditor and bank were instead handled in a manner that allowed the company to interpose itself. Where a confirmation is routed through, collected by, or returned to the client controls the evidence. Once the client controls the evidence, the confirmation confirms nothing. It becomes a document the company is effectively writing to itself and presenting as though a bank had written it. Step 4. The maintenance of internal consistency. A fabricated cash balance cannot stand alone. Cash on deposit generates interest income. Interest income flows to the income statement. If the cash is fictional, but the interest is real on the books, the fabrication is internally inconsistent and detectable through simple recomputation. The record shows Satyam maintained the fiction by fabricating the interest income to match the fabricated principal. The forged fixed deposit receipts supported forged interest accruals, and the forged interest accruals supported the reported earnings. The books were internally coherent. That coherence is what allowed the fraud to survive analytical review, because analytical procedures test whether the numbers are consistent with one another, and these numbers were consistent with one another. They were simply consistent with a fictional reality. Step 5. The scale problem this created. Because the fabricated cash was reported as real, and because real cash earns real returns that a company can spend, the difference between reported cash and actual cash had to be continuously managed. The reported figure grew. The actual figure did not. The gap widened over successive reporting periods. This is the mechanical meaning of Raju's tiger. A one-time overstatement can be quietly absorbed. A structural overstatement that must be refabricated every quarter, with matching interest income every quarter, compounds. Each period's audit required a fresh set of forged confirmations consistent with the growing fictional balance. The fraud was not a single act. It was a recurring production process with a fixed output requirement that only increased. Now, the detection question. Why did the verification chain fail for as long as it did? The confirmation procedure is the auditor's strongest single tool for cash. Its failure at Satyam is therefore the most analytically important part of the case. The vulnerability is structural, not a matter of effort. If an auditor permits the confirmation request to be transmitted through the client, or accepts a returned confirmation whose provenance the auditor did not independently control, the procedure's independence collapses silently. The auditor may perform every step and document every step, and the file will look complete. But a confirmation the client touched is not an independent confirmation. It is a client representation wearing the costume of independent evidence. The SEC's enforcement actions in this matter reached the auditors. In April 2011, the SEC announced a settlement with 5 India-based affiliates of a global accounting network in connection with the Satyam audits. The Commission found that the auditors did not comply with professional standards, specifically in the confirmation of cash and short-term investment balances. The finding was that the audit firms failed to follow the standard requiring auditors to maintain control over the confirmation process, including the direct receipt of confirmation responses. According to the SEC's order, the confirmations were not received directly by the auditors from the banks in the manner required, and the auditors did not perform adequate procedures when the responses raised the possibility of a discrepancy. Consider what would have had to be true for earlier detection. The auditor would have had to insist on controlling the confirmation channel end to end, preparing the request, controlling the mailing, and receiving the response directly at the audit firm's own address with no client intermediation. Had that single control held, the forged confirmations could not have been substituted into the file because the genuine banks would have reported the genuine, much smaller balances directly to the auditor. The entire fabrication depended on the client's ability to stand between the auditor and the bank. Remove that position, and the fiction has no channel through which to travel. The unraveling began not with the cash, but with an attempt to spend it. In December 2008, Satyam's board approved a proposal to acquire two companies, Maytas Properties and Maytas Infrastructure, entities associated with the promoter family. The stated rationale involved deploying the company's large cash reserves. The market reaction was immediate and negative. Investors questioned the related party nature of the transaction and the diversion of cash. Within roughly 12 hours, the board reversed the decision. The reversal is the structural pivot of the case. The Maytas acquisition would have converted fictional cash into a real asset. It was, in effect, a mechanism to make the missing money disappear into a legitimate-looking purchase. Once the acquisition was blocked, the fictional cash had nowhere to go. The gap could no longer be hidden inside a transaction. It could only be disclosed. On January 7, 2009, Raju sent the confession letter. In it, he stated that the balance sheet carried inflated cash and bank balances, overstated debtors, understated liabilities, and an overstated operating margin. He wrote that the gap had grown over years and that every attempt to eliminate the gap failed. The enforcement sequence followed. Indian authorities arrested Raju and others. In the United States, the SEC and the Public Company Accounting Oversight Board pursued the auditors, given Satyam's American depository shares listed on the New York Stock Exchange. In April 2011, Satyam, then operating under new ownership, settled with the SEC and agreed to pay a $10 million penalty in connection with the fraud. The same month, the auditor affiliates settled with the SEC and the PCAOB, with the audit firms agreeing to a payment of $6 million and to a bar from accepting new US issuer audit clients for a period. Years later, Indian courts convicted Raju and others of the underlying fraud. What the Satyam case establishes is structural, not moral. It demonstrates that the single most trusted audit procedure for the single most fungible asset fails completely if the confirmation channel is not independently controlled by the auditor. The forgery of documents was not the decisive failure. Documents can always be forged. The decisive failure was that the forged documents were permitted into the audit file through a channel the client could influence, when the confirmation procedure exists precisely to route around the client. The regulatory response addressed the channel directly. Confirmation standards and audit practice moved toward electronic confirmation platforms that transmit requests and responses directly between auditor and financial institution, removing the client from the path entirely. The finding of the case is that a control is not the procedure performed. It is the independence of the evidence the procedure produces. When the client can touch the evidence, the control has already failed, regardless of how completely the steps are documented.